Hello friends, welcome to our channel Crackon. So this is our series like CIB. For the CIB we are discussing. So in this session we are going to discuss Basel norms, right? So one second, let me. So in this Basel norm, as we know, this is very important one for the banking industry to follow the rules and regulations for the so this is something we are going to discuss Basel norms. So very important one with respect to exams. We can expect something, some theory mark questions, 3 to 4 mark questions from this chapter, right? So this is very important in case of bank financial management, right? BFM topic. So like always, if you are new to our channel, then subscribe it so that you will never miss any updates from our channel. So I am Sumant. Welcome to our channel. Let's start it. So, what do you mean by Basel norms? So, for example, if we talk about the Basel committee, that is, why we need these terms. The main important thing is that why we need all those things. So, Basel committee, that is one, banking supervision. So, Basel committee on banking supervision, BCBS. This is the full form, banking Basel committee on banking supervision. जो बेसल कमिटी है इसका जो मेन है प्राइमरी ग्लोबल स्टैंडर्ड सेटर सो एक ग्लोबल स्टैंडर्ड सेट किया है for the prudential regulations of the bank. So it's normally main important reason for the regulation of the bank, right? So there are many regulations have been you know uh, created by this committee. So something like 1, 2, 3, Basel 1, Basel 2, Basel 3. So it's like have something like 45 members and comprising of central banks, all the banks like central banks and bank supervisors from 28 jurisdictions, right? So main important thing is here that the committee who is is handling all these Basel norms is like Basel Committee on Banking Supervision. So main goal of this norms are to supervise the banks, right? So next one is the set of regulations by the BCSB, which mainly focus on the risks. So main important that when we as a bank we are dealing with most importantly like risks. We are doing something financial business. So in that financial there are many factors are related, right? Market risk. So in the BFM module 2 we are dealing with all the risks, right? Market risk, interest risk, credit risk, all those things. So to deal with all those risks related to the banks, the financial systems are related to banks and any other financial systems. So the set of agreements by the or set of the regulations by the BCSB, Banking Committee on Bank, Basel Committee on Banking Supervision, are called Basel Accords. So there are some regulations created by them for the proper supervision, proper regulation or proper something like utilization of the banking financial system to face or to cope up with all the upcomings or all the relative risks, right? So what's the purpose of this? So main important thing is here that the purpose of all those things is like, so here is one thing that what is the purpose of this? Simple thing is that to ensure the financial institutions have enough capital on account of meet obligations and absorb unexpected losses. Right? See, whenever we are dealing with the financial things, there are many risks. Right? So if this is the bank, so there are many risks with respect to the banks. Right? So like if you are as we know bank are dealing with one thing is credit, another one is deposits, so payment and loans. So in that case with respect to the one we are giving the loans, credit factor that is depends that is related with many risks. So in that case to cope up with all those risks we need some guidelines so that we can or the bank can face the all possible or unexpected losses. So whenever the risks it never say that मतलब बता के तो नहीं आएगा ना कि लॉस ये वाला रिस्क जो होने वाला है जैसे कि मार्केट में जैसे कि अभी जो पैंडेमिक सिचुएशन के लिए हमारा मार्केट अभी थोड़ा डाउन चल रहा था, ठीक है. सो इट्स लाइक समथिंग लाइक मार्केट and the situation, the whatever the situation that those are completely unexpected one. So to cope up with all those situations, we need all those regulations. And so main important is bank should ready to face all those unexpected losses. So this is the important point. Or it's like there are some minimum capital all the banks should have, all the financial institutions should have, so that they can at least withstand the unexpected losses or unexpected situations, right? So this is one, in the Basel we can divide like that. So this is Basel. So Basel is three types. It's not three types, but it started with Basel 1, right? So next it's upgraded to Basel 2, and next some additions are there with respect to the situations, because situations are changing day by day, or every time it's changing. So next upgradation is Basel 3. Right. So we can see these are the three pillars of the Basel or the regulation of the banks, right? To meet the obligations and unrestricted losses. So first one is Basel 1. Right. So here so it's introduced, first Basel 1 was introduced in 1988. Right. So it's the Basel one mainly focused almost entirely on credit risk. I told you that many risks are related, right? If you have covered the module B, then you can see there are many risks. So mainly initial stage, the Basel one is mainly related with, or entirely focused on credit risk. Credit risk means whenever big bank giving loan, this is the customer. We can say like this. So this is the customer. So we are giving something loans, right? So in that case, we are checking something. Whenever we are dealing with the credit, so the C word is main important, right? Credibility, credibility. That means the ability of the customer to repay the loan. So while we are giving the loans, or all those things, apart from all the securities, all those things, we are considering main important factor, that how the customer is, and one more thing, credibility, and another one is character. So that's important thing is that whenever customer is credible, is able to pay his income, he has a good income sources, right? So good income sources, then only we lend the loans. But still, in some unfortunate situations, the customer, that is the customer, is unable to repay back, right? So unable to repay back the loans. So in that case, the credit risk arises, right? So it's defined capital and structure of risk weights for the banks, right? So Basel 1 mainly related with the credit risk. So the next one is like that. The minimum capital requirement was fixed initially. Basel, as per the Basel 1, the minimum capital was fixed at 8%, 8% of risk-weighted asset, right? So the minimum capital that is fixed initially, that is 8% of risk-weighted asset. So this is important one. They normally ask as per the Basel 1, okay, how much percentage of fixed that is with respect to risk-weighted asset. So they can also ask 8% of what? That is, the definition is RWA. So that is risk-weighted asset. So whatever the assets, risk-weighted asset. See, with respect to, we are thinking with respect to bank. With respect to bank, what are the assets? Assets, that means for banks, the loans, all the lendable items, loans, and whatever because we are giving the loans to the customers, and in return we repay back we got the money back in terms of something repayment. So that means all the loans are something like asset for the bank, So these are the asset for the bank. So as simultaneously, as we know, all the deposits are liability for the bank, because whenever customer demands, the bank needs to give back the customers the required amount as per the requirement of the customers, right? So here one thing you just remember, 8% of the risk weighted assets. So India adopted Basel I was introduced in 1988, but in India it's adopted. It's like global one. So it's India adopted in 1999. You can easily remember something like after 10 years. India adopted Basel I guidelines 1999. So next after that something Basel II was there, right? So as you know, the Basel one is related with only credit risk. There is some requirement of upgradation in the guidelines, right? So this is, we can say, this is the upgrade version of Basel one, right? So this is introduced, that is first published in 2004. We can say that is 1988. So after something like 15 years. So after 15 years, the Basel II term, Basel II was published in 2004. So the guidelines were based on three parameters. So first one is something related with the credit risk, that is Basel I. But here the guidelines is related with something like based on three parameters. What are the parameters? Here we can see banks should maintain a capital adequacy. So first parameter is banks should maintain a capital adequacy of 8% of risk assets. So banks should maintain capital adequacy, means capital requirement, whatever the capital, whatever the asset, risk asset bank is having, they should maintain a minimum percentage of 8%. It's like a reserve, right? So reserve capital of something like 8% of risk asset. That means in any opportunity situation, all the banking, all the financial institutions should have 8% of their assets, right? Of their risk-weighted assets. It's like not risk assets only, that is RWA, risk-weighted assets. So some additional things are there, like banks were needed to develop, use better risk management techniques in monitoring and managing all three types of risk, that is credit and increased disclosure requirements. So the three types of the Basel one is more focusly on credit risk, right? So more focusing on credit risk, but Basel II is focusing on some more risk, because with respect to the situation and time, it's getting increased, right? Like operational risk, market risk, and capital risk. So this is one, this is one, something like additional thing. So here also included operational risk. So as we know, operational risk means some human activity or any operational related risk. Market risk means is related to the market, fluctuation of the market or whatever the situation of the market like. So like that, the market risk also include interest rates and all, right? So we are also going to discuss all those risks in the deeply. So just remember here three factors, three other risks are also included, and another one is capital risk, right? So bank needs to mandatorily disclose their risk exposure to the central bank. So before that, this regulation was not there. But after the Basel II norms were there, as per this, its banks need to mandatorily, means compulsorily, disclose their risk exposures. That means whatever their risk percentage, that bank cannot hide all those things. He need to he need to inform the central bank. So in our India, the all the banks need to tell the risk exposures, like what are the risk percentage to the RBI in regular interval. So that it's like the RBI can, or the central, it's like central bank means in all the country there is one some central bank. In India it's RBI, right? So RBI can analyze the risk percentage or risk exposure. Accordingly, RBI will suggest the something like solutions for that, right? So it's like the regulations or credibility, or you can say supervision of the financial institution can be done in a good way. So after this is all about something Basel II. So in after that some operations also required, like that was also included in Basel II. So here we get Basel III. So as per Basel III, it's like in 2010. Why we need Basel 10? See, we know in 2008, as we all know, in 2008 there was a financial crisis, right? So in USA we know one the bank was completely due to that downgrade of that bank. We globally we can see like it's like a financial crisis, right? 2008. So due to that, in response to that financial crisis in 2008, Basel 10, sorry, Basel III guidelines were released in 2010, right? So it's like in 2008, it's like the financial crisis. We can say that that is caused due to the deregulation in the financial industry, right? So it's like something deregulation in financial industry, right? So it's like completely more now all over globally we can say all the banking system were affected, right? So there are many things like permitted banks in that time. The banks are permitted to engage in the hedge funds trading with the derivatives. Some more deeply we can discuss in other topics. So in this topic we need to go more deeply, but just remember, so it's like that. And then you can say there are some deregulations in the banking financial systems. So due to that financial crisis was happened, and after that globally new guidelines were required to manage all those things. So that's why Basel 3 were also in 2010 Basel 3 guidelines were released. So you can say from 2008 to 10, it's completely going in that we need the whole banking system needs some new guidelines to cope up with all those types of deregulations, so that these financial systems will not repeat it. So before this pandemic situation, we can say this is the greatest financial crisis happened globally, right? So that also caused something like global great recessions, right? So so as per the Basel 3 norms, we can say, so as per Basel 3 norms, the main importantly, this norm aims to at making most banking activities such as trading book activities are more capital intensive, right? So their trading book activities like financial crisis what happened, like more banks are engaged with hedging of the funds. So if you are aware of the stock markets, then hedging plays important role to deal with the stock markets, right? So hedging funds with derivatives. So there are some misregulations with respect to that, right? So that's why you can say the Basel III main importantly. So that's they are trading book activities more capital intensive, right? So the guidelines aims to promote this guidance also aims to promote a more resilient banking system by focusing on four vital parameters. So here some more vital parameters are also included, that is capital, leverage, funding, and liquidity. Right. So in Basel 3, some more the main focusing parameters are like capital, leverage, funding, and liquidity. Right. So presently, Indian banking system follows Basel II norms. So we can say the guidelines are there that something, but now the Indian banking systems are following Basel II norms, right? So the guidelines to adopt the Basel III norms are like, so it's like the regulations are need to be implemented by something like it's like 1st January 2023, but and including this, what is the main difference if we talk about the main differences between something like Basel 1 and Basel 2 is like the addition of all those. Here the addition of the capital and leverage and funding and liquidity. These are the terms. So leverage means it's like leverage ratio was also added, right? So including this, there are three pillars, you can say. So three pillars are also there. So first pillar is like enhanced minimum capital and liquidity requirements. So we can say capital and liquidity requirement. And next one is enhanced supervisory review. So another one is something like supervisory review, right? So the third one will be like enhanced risk disclosure and market discipline. So the third pillar is risk disclosure and market discipline, right? So here it's like C for capital and L for liquidity. So we can see in Basel III there are many new things are also added like leverage ratio, right? So leverage ratio, and next one is some more terms like LCR and NASFR. LCR means liquidity coverage ratio. Right. So NSFR. So here I am writing NSFR. This is another ratio. So which is also included, that is net stable funding ratio. Net stable funding ratio. So in India, the guidelines for the NSFR of 100%. The banks in India were required to maintain NSFR something like 100% net stable funding ratio. We can see funding what is also used. Last our term is 1 April 2020, but due to the situation is now increased to 1 April 2021 by the RBI. We can say RBI has extended 1 year so that all the banks in India should maintain 100% of NSFR. 100% of NSFR in case of India, right? So this is just a basic definition, basic idea of the something like Basel terms, right? So we are also going to discuss some MCQ related this, and in upcoming days, in upcoming sessions, we are also going to discuss some all those terms like all the ratios, what is leverage ratio, what is the NSFR, and what is something like all the ratios. We are also going to discuss LCR, liquidity coverage ratios. So in the upcoming day sessions, we are also going to discuss, right? So after this, we are also going to have one MCQ session regarding the vessel. So hopefully in this session, we will have some basic idea of the vessels, and stay tuned for the next upcoming sessions. Thanks for watching the videos, and keep watching and like, share, subscribe to our channel so that you will never miss any updates. So that click the bell icon so that you will be updated to our all the latest recent notifications. So keep learning. Thank you.